Can I ask, while, can I request Connie Chen? She's Director Legal, Cisco. I think she's all right. Okay, no problem. She'll be walking in soon. Then Puneet Shivam, Head Avendus Capital. As you know, Avendus is one of the new generation finest investment banking group, and Puneet heads their US operations, and they have done, I think he'll be able to tell a little bit more about you. Why don't you tell a word before I call somebody else, a little bit on Avendus, because I see that you have done a great job. You can press that. Yeah, sit down, no problem. Take it. Great.
Good afternoon, everybody, and thank you, Nishit. It's always a pleasure
to
share a stage with you. It's actually an honor. So, folks, very quickly, let me just quickly cover what we do as Avendus. And we have worked with Nishit Desai, I don't know, probably since our inception. In short, what we do is that our specialty is cross-border transactions, generally with one leg related to India. It may not be India company, but related to India. So over the last 16 years, we must have done about 120 transactions. And we have now expanded into almost all verticals that are there. So we end up seeing the ups and downs of the market, and also the impact of various policy issues and legal issues. So what I hope to do today, I head up the US practice. Actually, I started the US practice about a decade back. So what I hope to share with you today is what we see from a banker perspective, how the regulatory, legal, policy issues interact with an M&A transaction, and how that dynamics play out. And as practitioners, whether you're a legal practitioner, an entrepreneur, or a banker, what I'll try to highlight is how you can navigate, because there is a longer term discussion around how policy would change, but that is in the court of legislatures or executives. For where our practitioner view comes in is how do we navigate what is out there and what impact we see. So I'll try to share those insights with you.
Thank you so much. Connie, welcome, most welcome. And as I explained told you earlier, she's Director Legal at Cisco. And Connie, would you like to say a little bit about what you've been doing and in terms of your legal thing and a bit about your, you can. Yeah.
And it's about 40 professionals all over the world that work on Cisco investments as well as Cisco acquisitions. So that's not split up within Cisco. We work on both types of deals as well as JVs.
Thank you so much, Connie. And may I introduce Webunar Parikh. He's a partner in charge of our technology practice and VC private equity investment. He's done a lot of things. Weber, you want to say a word?
Yeah, I'm based in Bangalore. I do a lot of work on private equity, technology, and M&A. And I was based in Bay Area in 2010. And a lot of my work includes cross-border transactions between, especially technology companies between here and India.
Thank you. And Simon, right? So Simon heads our M&A practice group co-heads, and okay, sorry, no problem. So Simon, would you say a word or two about what you've been doing besides reporting to Weber?
Sure, Nishi. Welcome everybody. I think we're seeing very exciting times in M&A in India, and we hope to share some of our excitement with you. So, we're going to be covering a lot of things, including M&A, competition law, especially in the tech sector, and we hope to have an exciting debate today.
Yeah. May I request Mahesh Kumar? Where are you? Oh. Mahesh. Tell people about yourself a bit so people can relate.
Yeah, I head our tax practice out of our Singapore office and advise a lot of several MNCs, not only in the APAC region, but also a lot of the US MNCs, EU MNCs, getting into the APAC region and specifically India, and Singapore becomes very relevant of that. And also advise a lot of Indian companies globalizing on both strategies and also structures. Yeah.
And Mansi, just you already introduced, but it will be good, your specialty, what you've been working on.
So I actually head the US office. I have my specialty is in international tax and funds, and I've also been involved in M&A transactions.
Thank you. So I think we have great people around here. All these are my brain counts. I am the head count of the organization. Just bear in mind that difference. And it's been very nice to have you all today. This particular session, I would like Punit to start with and tell us as to what all is happening. Of course, I rattled out a few statistics, but you know a lot more about this industry, where it's heading to, what are the areas of interest, what's happening. It would be wonderful people to know a little bit about what's going on.
Thank you, Nishit. One thing, if I may, let's keep the interaction very interactive, the session very interactive, because best, I think, insights come in from insightful questions. So I would welcome any question to any of us as we go through. Rather than keeping it like a monologue, let's keep it a dialogue. With that, let me just mention something which is very true in M&A world or any world economy. Right now we are talking about US-India. Is that there is always multiple views on a particular issue. So let's keep that in mind. In general, if I look at on the positive side of what is happening between US and India, the integration of economies and businesses is moving faster than ever. The numbers that Nishit said, we all can see those numbers. It went through a peak around 7, 8. It declined and it's back up. But those numbers are, in my view, are only partial story. The big story is that the business are getting integrated very much more. The business models are becoming very similar. So in all, there is a increased interaction between the two economies and two corporations from these two countries. On the flip side, there are certain economic headwinds, which are both economic and regulatory. So economic headwinds are the BRIC countries have run kind of their course as a group. In fact, Goldman went out and said that the BRIC thesis is now withdrawn. Actually, it's run its course, because it was an excellent thesis, but it's kind of like many things, it's no longer a driving force of world economy. The second thing is that the currency structure in the world has become predominantly US dollar heavy. So that makes a certain type of economic activity and investment activity hard to pursue. And finally, which is probably more related to the regulatory legal forum we have today, is that the risk perception of India has gone up relative to the US. So US risk perception has gone down, as shown in all the growth and good returns and economic development, unemployment, stock market return, whatnot, that US has again emerged as the strongest economy in the world. And in contrast to that, India has not done that well, and the regulatory issues and tax issues have thrown further uncertainty in the mix. So in general, the investments coming into India are now discounted more. Whether they are financially discounted on an Excel table or in somebody's mind, they are far more discounted. So what's happening is that the action on India-US, while interest continues to grow, the action has reduced, and it will continue to be kind of a question mark till there is clarity on the regulatory and tax and executive judiciary framework. Because lately there has been, in fact today, some of you may know Jerry Rao, the ex-founder of Mphasis. He came out with a very nice note to the finance minister about the regulatory tax issues. People may agree with the technical detail of it, but the ethos and the sentiment of it was very nice. I'll encourage you guys to look at it. But coming back to the point that what we see the activity between India and US in certain select verticals to continue to increase actually significantly, which are verticals such as technology-oriented verticals and chasing Indian consumer. So if you really look at, generally bankers classify transactions into 3 categories: domestic, which means both buying and seller in India; outbound, where buyer is in India and sellers in US; and inbound, where sellers in India and buyers in US. So inbound activity will largely be chasing the Indian consumer, whether through e-commerce platform or directly. By the way, it may be a little surprise to some of you that over last 15 years that we have tracked the data, the largest single segment of M&A activity has been consumer, not information technology, not BPO, nothing's followed by infrastructure. So that shows you one side of the coin. And the other is that the outbound transactions are largely chasing newer business model and closeness to the customer. And they are driven largely by technology. So all in all, we believe that the trend of M&A between India and US will continue to rise. The transactions will take longer than average till regulatory framework slows down. And there will be more kind of risk adjustment, hence valuations outside e-commerce area in India will continue to be not stellar. They are still good, but not stellar. So I think that's probably a brief summary, but Mansi, I don't know, would you like to have questions now, or how would you like to?
Well, I think we can finish and then take questions, because some questions will already be answered by the time other speakers. So let's get into that, but if there is somebody very pressing, if somebody has real urge to ask a question, I would not stop. Anyone has any question right now? Okay, just hold on. We'll make sure that you are provided all the answers to the question that you have. But one thing I just wanted to do was to get, can I get the slide one? And then we can build on that, and all of you are welcome to, this is the one. Okay, yeah. See, in a typical simple world, this is all that matters, right? We are talking about US company has investors, sometimes from US, India, global, otherwise. That company wants to acquire Indian company, right? And it has assets. Now, this simple transaction, how will lawyers complicate because of different kind of things, right? And so what I would like to do is to say what issues can arise and why transactions undergo different kind of situations. So look at, there are US investors, US company, Indian company. You may just simply acquire a US company, okay? It's a US company, US shareholder, right? So you pay capital gains tax in the US, and you always assume that there is no implications in India. Now, most of you know indirect transfers have been introduced, so you can have some issues on that side as well. Then US company, which has invested in India, even though there is no transfer of shares, again, so we would like to discuss some of those issues. Let's see what are the different things that could come up. Other thing is that if US company acquires something today in India, do you need any intermediate company? Because in future when you sell shares, would there be any implications? Okay, so you add one more complication. One or two points which came up in our research about 20 years ago was that there is something called Code Section 865 in the US, which says that when a US resident sells the shares of, say, foreign company, Indian company, and pays capital gains tax abroad, that capital gain for US tax purposes is a US source income. So US would say, oh, here is our US company, here is a US asset, US cited. Even though shares are of Indian company, US considers it to be US source. So they have first right to tax. India says, no, the company is an Indian company and the shares of Indian companies are being sold. So we have first right to tax. This issue has not been resolved in India-US tax treaty. As a result, there is a potential double taxation of the same income because there is no availability of tax credit. Okay. So now what do you do? Okay. So when we were faced with this situation, we began to look at number of different jurisdictions and how do you structure and stuff like that, and tumbled on this small little island called Mauritius. So in our research, Mauritius came up, and I looked at this treaty. I said, oh, what's going on? India has only one or two tax treaties like that. We have over 85 tax treaties, but this is one of those treaties that have a provision that Mauritius company will not pay capital gains tax. Okay. So I flew down to Mauritius just to study. As a research-based law firm, we keep on doing those kind of things. Landed up 7 o'clock in the morning and met with people whether American companies can set up a company in Mauritius and can invest in India and stuff like that, because don't want to pay double taxation, no, obviously. And at that point of time, Indian tax rates were 25% on long term and about 50% on the short term. In the US, it was over 40%, and state level tax and the city level tax together would make a 55-60% tax. So if you have almost 55-60% tax in the US, India has another 25-30%. The rest is taken by lawyers. So what do? And in the process, when India opened up, it was capital gains situation was such it would have been a non-starter. Nobody would have invested in India, including the tax-exempt investors in the US and other kind of categories of companies. And then I spoke with the government of Mauritius and developed offshore financial center and set up first 5 companies in Mauritius. And they were all funds. I won't go into very great details, but first one was Barclays Fund Index Fund, Bombay Fund. Second one was Alliance Capital. Third one was George Soros and Chase Capital. We set up Walden Nico and stuff like that, and then became order of the day. And also government then recognized that this was what you call an acceptable thing. So lots of investment came just because of this particular syndrome. And in the last few years, some things have changed. Still, Mauritius Treaty continues. It's not terminated, it's going on, and I'll be happy to answer any question later on. But that's how, things become complicated, because countries do not have harmonized system of law. And that's what creates problems. And then lawyers come and try to solve the problem. Anyway, what I would like to do is, let's look at what are the other implications, and one more slide I would show. What are, let's say, Mahesh, would you like to say a little bit about this thing? There are different ways in which you can look at, investors. There is stock sale. There is a, oh, I think people can't see.
Yeah, can you have that slide? Yeah. No, just to give an idea, as Nishit said, there's so many ways in which M&As are structured nowadays, and of course, the most typical the option is the direct investment, where you have a direct sale of shares of an Indian company. But then again, the bigger question is it a stock sale or is it an asset sale? Each having their own tax, and of course there are some, if it's an asset sale, there are also indirect tax consequences apart from income tax. And then you have Indian tax consequences, you have the non-Indian tax. For example, if you have US investor, how do you integrate both of that? And then again, when you have stock sales, you have, if you see in this diagram, it could potentially happen at various levels. It could be direct, it could be at the first intermediary level, or all the way, if let's say at the stage of the founders exiting. So this slide essentially giving an overview of some of the M&A activity that you see, the various types, and of course we'll, in the course of this panel, we'll discuss the specific tax issues and how do you mitigate potential tax risks. And I don't know, Vaibhav, you want to add to some, yeah.
Sure. So as Mahesh said, we generally see a lot of varieties of way of how acquisitions happen in India and how they are structured. Most common way is share acquisition. That's also a preferred way. There are several benefits to it compared to the other options. However, what you see in US is doing a stock swap as a very common way of doing acquisition. In India, we see direct acquisition as opposed to swapping it with the stock of the acquirer company. And if you do a stock swap, there are a lot more exchange control issues and a lot more tax issues which kind of hinder the stock swap option. So even if you want to achieve a stock swap option, what we do is we try to do it as two separate, discrete transactions. We do acquire, will buy the shares of the target, and then the money which the founder receives for selling the shares of target will be invested back in the buyer's company to get the shares. So you will achieve the stock swap option by doing the two different discrete transactions, but going and doing a stock swap itself creates a lot of additional issues on tax as well as on the exchange control perspective. When you look at direct share acquisition, other than tax issue, which Mahesh will talk about, exchange control becomes a very key aspect you need to look into. In addition to your, what you otherwise are used to, keeping in mind whether it's terms of, Companies Act and other regulatory aspect. Exchange control, there are two major points we need to keep in mind. When you are purchasing a share of an Indian company, specifically from an Indian, let's say, seller, then there is a minimum price you need to pay to buy that particular share, and that does create some of the things which you will need to structure it in a right way so that you can achieve your commercial objective. If you are buying shares from a US company, and if you are a US purchaser, then obviously you don't need to worry too much about exchange control regulation. But if that purchaser, that seller happens to be a non-Indian resident, NRI, then again there are exchange control repercussions or approvals which will be required. So we need to keep that in mind. The other ways of structuring this, as Mahesh mentioned, is, let's say, a business transfer. So you have a US company, and let's say they have already an Indian subsidiary, and now you're acquiring an Indian company. So instead of buying shares of Indian company directly and then having two subsidiaries, you may choose to buy the business of the Indian company directly through your Indian subsidiary, right? Or you may choose to buy assets, itemized assets from the Indian subsidiary. So that's the other option which you can consider. Generally, what we have seen is that option is not preferred by the seller because the cost of transaction cost is substantially high compared to our direct share acquisition. Because an asset acquisition includes additional cost of what we call transfer tax or stamp duty, which otherwise is low when you buy shares of a company. In addition, there can be VAT or transfer tax if you do an itemized asset purchase. Also, the money then goes to the target company, and when the shareholder has to pull out that money, there is an additional dividend distribution tax. And also, because of certain corporate laws, not all money can be pulled out. And unlike in the US, it is not very easy to liquidate the company in India, and hence money extraction from the Indian company is little difficult and little tax inefficient. And as a result, doing a direct share acquisition, whereby the purchaser will pay to the seller himself rather than paying to the target, and then the seller then taking out the money from the target, and which is why about 90-95% of the transaction which you see in India are generally share acquisitions and not an asset acquisition or business transfer. You see business transfer and asset acquisition where there are a specific reason, right? For example, there are a lot of liabilities in the company, and you want to kind of not take that liability, and then you work out that particular asset purchase or business transfer as one of the method. There are other ways which can be done, which is like doing a restructuring, including demerger of a company by way of acquisition. Again, this is not very common because of the time delays and the complexity it gets in. So this typically gives you a rough flavor of what are the different ways of structuring acquisitions in India. There is one other way which we have seen is that if you have a US company already is an Indian company, then instead of US company buying shares of Indian company, you have Indian company which buys shares of the target in India, and then later on does the merger. It brings its own issues in terms of tax as well as in terms of exchange control, even though it is simply acquisition by one Indian company to another Indian company, because the purchaser, which is the Indian company, is owned by a foreign parent. There are certain downstream exchange control regulation which also kicks in, and maybe we can talk about this a little later. Thank you.
Thank you so much. Connie, may I ask you a question? You've been doing a lot of work in the context of India, and what are the key issues would you recommend the US companies to look out for while acquiring a stake in an Indian company? So, it would be very useful guidance to people here.
Sure.
Yeah.
Can you hear me? Okay. So I would say that in the last 7 or 8 years, Cisco has done about 20 equity minority investments in Indian companies. We've never done an acquisition because we really didn't feel comfortable that we could affect a squeeze out. And in several of the targets we were looking at, there were hundreds of shareholders. And we didn't want to not wholly control the entire company. And so to date, Cisco has never done an acquisition in India. On the investments that we've done, I would say that the only challenges really have had to do with more of the corporate law side and not the tax law side, as it relates to trying to put together a preference instrument that looks like a Silicon Valley preferred share that may have put options and other things that could be construed as debt under Indian law. And so it's just trying to build in a lot of the protections that investors look for in US deals into the Indian model. The one story I wanted to share with you, because I'm not the legal expert, but I definitely have a couple of war stories from our years of doing deals there, is that you really can't skimp on doing diligence. A few years ago, we bought a US company that had an Indian subsidiary. And it was seen as kind of a pretty small entity that really didn't do much business. Maybe it was the entity that had some engineers. So we didn't really look that much into it, but after the sale closed, we wanted to just dissolve the entity and bring all the engineers over to a Cisco Indian entity. And as it turned out, the Indian entity had offered some Indian citizens investment in the parent company. So they took money from the Indian citizens and issued shares of the US parent to these Indian citizens. But because of currency regulations, they could never get the money out of India, and so they just kept it sitting in the Indian subsidiary. So by the time that we came around to wanting to dissolve the entity, we only had one choice. We either had to issue shares in the Indian subsidiary to these investors, or we had to give their money back. But they already got money from the proceeds of the sale at the parent level. And so we were in the situation where we couldn't do anything about dissolving this Indian subsidiary until we cleaned up the problem. And so, the one cautionary tale that I have is that you just really cannot skip doing diligence at a subsidiary level, even if you don't feel like it's a very material part of the transaction.
Mahesh, I just have one question for you. That in the US, often the acquisitions are structured as reverse triangular mergers. And do you have any comment on that? And maybe Connie, you want to add something, you can add as well. But Mahesh, just for a moment.
Yeah, no. So while that's quite common in the US, in India, it's usually you would not have a merger or acquisition structured as mergers. Usually mergers and demergers are all in normal, usually as part of business restructuring, rather than as exits or as part of M&A. Of course, you do have, let's say you have an M&A in the, let's say a reverse triangular merger at the US level, which has indirect implications in India. Of course, those are situations we do see, and they have tax implications. But probably, Nishit, if you're fine, probably I could comment on some of the tax issues and some of the merger structures we've been looking at.
Yeah, that would be good.
Probably if you could go back to that slide.
Yeah, it's right here.
I think when you're looking at a direct scenario, right, as in US investors selling shares of an Indian company, and then Nishit explained there's a reason for having investing into India either through a Mauritius or a Singapore vehicle. And because firstly, there's a big advantage from a US perspective. You avoid this double tax issue. But again, for the benefit of those who may not know about Mauritius or Singapore and why is it relevant, probably just a very quick snapshot. Now, around 40% of India's FDI has come through Mauritius. And then, of course, then you have Singapore, which is number 2, around 10-20%. And the main reason is that India has very good tax treaties with Mauritius and Singapore, where an investor based in Mauritius, or a Mauritius company or a Singapore company sells shares of an Indian company, while capital gains tax in India could have been as high as around 42% or probably around 20% for long-term gains, it is reduced to 0. So there's no tax in India. There's anyway no capital gains tax in either Mauritius or Singapore, and there's only tax once investors take it back to the US, right? So there you're able to avoid a double tax scenario by completely eliminating tax liability in India. And that's the reason why around 50 to 60% of investment into India is structured through either Mauritius or Singapore. There are other jurisdictions which were popular. Of course, for example, if you take Cyprus, but because of the economic issues in Cyprus, and of course, Cyprus has also been blacklisted by India. So Cyprus is no longer popular. Otherwise, Cyprus would have been the best route to invest into India, whether it is equity or even debt investments. But now Cyprus is not considered an option. There are several Dutch structures which are also used, but usually for portfolio investments and essentially by funds, we're investing on markets. But for strategic investments into India, it's still Mauritius or Singapore. And over the last few years, we have seen a slow shift from Mauritius to Singapore. And this is in line with global trends where idea is whenever you do structuring, you have to think of substance. You have to justify, you need to have non-tax reasons why you are in a specific jurisdiction, whether you're in Mauritius or whether in Singapore. The general feeling is that it's easier to perhaps set up this some sort of a credible presence in Singapore as opposed to Mauritius, have decision makers or managers or directors posted on the ground in Singapore. So that's why the general sense is investing into India, you're able to manage substance in Singapore better than you would have if it was Mauritius. Of course, the other advantage Singapore has is that it's a disadvantage and a disadvantage. This capital gains exemption, that is when a Singapore company sells shares of an Indian company and does not pay capital gains tax in India, this exemption is subject to certain substance thresholds which have been prescribed. For example, you have to incur 200,000 Singapore dollars operational expenditure each of the years prior to the sale of shares. So then you are deemed not to be a conduit, and you have enough substance in Singapore to take advantage of the treaty. Good thing is it gives a lot of certainty. You're not going to get into a lot of litigation on is this just a shell company? Does it have substance? Can it be denied? So it gives some sort of certainty. So that's where and of course Singapore, the ability to have create some sort of a presence. Singapore that way is getting is taking some of the shine out of Mauritius, but does not mean Mauritius discontinues. Of course, Mauritius is also continuously reinventing itself. They are also focusing on a more South Asia and also an Africa kind of. In terms of regional headquarters or regional holding company for both India and for Africa. And in fact, the India-Mauritius treaty also is being renegotiated at the moment, and it's expected that it is going to be on par with Singapore in terms of these substance thresholds. So then the idea is you incur this much expenditure, and you're deemed to have the substance in Mauritius. Now, the reason all this is being done is so that you don't end up in a double tax scenario and you don't end up having to pay a significant capital gains tax in India, which is quite high compared to, in fact, not only APAC, but in fact, it's probably comparable with the US as well. So you do not want to pay, you want to mitigate that tax in India, and you do not want to have double tax in the US. So you do not want to get into issues of tax credit in the US. That's on Mauritius and Singapore. That is when you have a direct exit from, you directly sell shares of an Indian company. And again, it is not just an M&A scenario, but also corporate restructuring, because there is a lot of tax exposure when you're just doing a business restructuring. There is no income event, there is no sale event, but still just a restructuring itself can result in significant Indian tax exposure. I mean, just to give you an example, a live case. So there's a huge deal between a Japanese group and an American group, and of course there are massive assets in India. Now, prior to the merger, it's actually an international joint venture. Prior to that, we are restructuring all the Asia assets, So the shares of an Indian company were directly held by this Japanese company, and the Indian company is listed. All we want to do is transfer these shares into another group company and then sell it at an offshore level. None of that should actually be subject to tax, and this is just a transfer of shares of an Indian listed company. But because it's being held directly from Japan, the transfer to a group company would have to be done at arm's length, that is at fair value, and we are looking at around $100 million of potential tax just in a group restructuring, which normally should not have been there if this investment was initially done through Mauritius or Singapore. Right? Just to give you an example of how even in a non-exit, because sometimes there is an assumption that we'll never sell. The Indian company is only a cost center. We may not really exit from India. We always hold this company, so we don't really need to look at Mauritius or Singapore. But it's not just exit scenarios, it's also restructuring. We need to be, having Mauritius or Singapore really provides that flexibility where you can do restructuring and structure exits without any tax leakage in India. And so that's on direct M&A. Indirect M&A is very interesting issues in India, and there's been a lot of controversy on that, because if you look in this diagram, let's say at number 1, let's say there's a US founder exiting and selling shares of a US company, or even below that, let's say you have a US company selling shares of a Mauritius company, which has an underlying Indian subsidiary. Now, here you're talking about a non-Indian investor selling shares of a non-Indian company to a non-Indian buyer. Everything outside India, but India still taxes it on the assumption that you're transferring a non-Indian company, but you've indirectly transferred an asset in India because the underlying Indian company is a substantial part of the non-Indian company. So let's say there's a Singapore company above an Indian company. Singapore company is held by a US investor. Now let's say the Indian subsidiary under Singapore is the only asset under that. So when the US company transfers shares of the Singapore company, India imposes a capital gains tax, which could be as high as 42%. And then there's a huge issue of whether you'll even get any credit for this tax in the US, because this is not a tax that is recognized under tax treaties. In fact, the US tax IRS has also made, because after India introduced this rule, the infamous Vodafone issue, the litigation and the retrospective tax, this is the tax that everyone's been talking about. And after India introduced this, China also introduced the same rule, right? And the US IRS made a comment that if you pay tax in China, we are not giving you credit in the US because we don't recognize any indirect transfer of assets. Because the treaties generally recognize only a direct transfer of assets. So that becomes a big issue, because in a lot of cases, the M&As are structured at a global level, and you will always have an Indian subsidiary underneath. And then the first question is there a risk of tax liability, not only for the seller, but even for the acquirer? Because if the acquirer, while acquiring, if the acquirer does not withhold tax when it should have been withheld, the acquirer is liable to pay the tax along with interest and penalties. And in going back to Vodafone, the funny thing is it was Vodafone was the acquirer, Vodafone was not the seller. It was not Vodafone's money. Vodafone bought the Indian operations of Hutch, everything structured outside India. So that is a Dutch company selling a Cayman company, or buying a Cayman company, buying a Cayman target from a Cayman seller. The Cayman seller was under Hutch, and Dutch was a Dutch subsidiary of Vodafone. Everything outside India, but Vodafone got dragged into this litigation. It was a $3 billion tax claim. We won in the Supreme Court, and then there was this retrospective law which overrode what the Supreme Court said. So again, the entire risk was on the acquirer. The tax department never went after Hutch for the tax claim. It is still Vodafone handling this litigation, and it's still going on now for the last 5 years, right? So from an acquirer's perspective, there are several challenges. And of course, I think towards the end of the panel, we'll discuss some of the risk mitigation strategies, both contractual and otherwise, how to manage these liabilities. But when you have these global acquisitions even on a non-India level, there's a significant risk of tax liability in India, and we need to identify the risk, assess what is the likelihood of that risk, because, for example, India could be only one of the subsidiaries within the group, right? So then, and the good thing is our 2015 budget has clarified that this tax, indirect tax apply, if you could go back to the slide. Yeah, thank you. The indirect tax applies only if the Indian subsidiary, the value of the Indian subsidiary is more than 50% of the global enterprise value. So that's a good amount of certainty, because at one point in time, tax department is even arguing that's fine. It's Indian subsidiary is only 10% of the global assets, but that 10% is $1 billion. So that's enough for Indian tax department to litigate. So at least the good thing is we have certainty now that it has to be 50%. So a lot of several deals end up getting out of this tax because the Indian assets may not be more than 50% of the global assets, and of course, there's also a exemption for smaller shareholders. For example, you're trading in Microsoft shares. Just because Microsoft has more employees in India probably than in any part of the world does not mean that someone trading on Microsoft shares should be liable to tax because of the underlying Indian assets, right? Because, so small shareholders again are exempt from this tax. So that's a good thing, but still in deals where the underlying Indian assets are quite significant, we always encounter this risk. You end up spending sometimes 40% of the negotiation time discussing this, the tax liability and how to apportion this tax liability and how to mitigate this risk when possible. And of course, all this structuring, whether on a direct acquisition M&A that is involving Mauritius or Singapore, or an indirect M&A, all this has to be looked at in light of this thing known as GAR, which is just around the corner. It's the General Anti-Avoidance Rules in India. It has been introduced. It is supposed to trigger from April 1, 2015, but now it has been deferred to 2017. Now, GAR is going to be another game changer. It is going to impact most of the conventional structures for investing into India. And again, GAR is something which the whole world is moving towards. Even the US, they have codified economic substance. Idea is you can't just rely on the form of a structure. You have to start focusing on substance. And it takes us back to whether you're investing through Mauritius or Singapore, you need to start having non-tax reasons for being there, and also ensuring that all that is documented, so that if there is any litigation, you can always justify that the structures were not only designed to achieve tax benefits, but there are several non-tax benefits why this is being done. So GAR is an important consideration. And before I hand it over, another development we're seeing, and again, this is to get around or to avoid situations where you may have to transfer shares of an Indian company directly and get into all this tax liabilities and how do you manage it. Several companies, in fact, several very interesting startups, and also existing companies where we are inverting them out of India. Ideally, you look at a structure where the ultimate holding company of the group is a non-US, a non-Indian. You do not want it to be subject to the high US taxes or the high taxes in India. And again, so that global investors can get in and get out with limited tax exposure. So we're seeing a lot of inversions. Indian companies inverting out. So we are flipping them. So even if they're Indian founders, US founders, Indian company, or even the US company, even seen some, of course, there's a lot of debate in the US on inversions. It gets a little more complicated in the US, but in India, there's some scope for doing such inversions, and that's why Singapore is becoming very important for this, because for a lot of companies, especially where you have a strong Indian leadership, Singapore is something very natural, and in terms of building this substance on the ground in Singapore, a lot of the founders, entrepreneurs are finding a lot of comfort in that, and so the idea is to have. So if you're doing any exit, it does not have to be of an Indian company. It'll always be at an offshore level. So that way you're completely out of Indian taxes. So that's also a development which is happening, and of course it's linked to this entire M&A environment. Yeah.
Thank you, Mahesh. I think a very good talk to my small question. It was very good expose, and thank you so much, because these are the kind of issues really need to consider. Just to the early point, and. You talked about Singapore and Mauritius and Indian perspective. What I would like, Mansi, you might have a little comment on that, because you have practiced in India international tax. Here you've been doing it. You got both sides, and of course you've been an IBA scholar. So if we can get some scholastic view as to how, from the US side, you will look at
Sure. So I think I'll pick up one point which was already mentioned by Nishit and Mahesh about the fact that when you make direct investments from US into India, there is a possibility of double taxation and you have to pay tax in both jurisdictions. Now, in some cases, such a situation may not be a big problem when you can get credit in the US, for instance. But what is the added complication in these direct investments is that because of the way the rules are worded, there is likelihood that actually the tax that you paid and the credit that you're getting may not be matching at the same time or in the same transaction. So it results into not only double tax, but also possible loss of credits in the US. So that is more from the seller's side. Even when I think in acquisitions, when from a buyer's perspective, when you're getting into this, I think from a US perspective, it's really given the stringent anti-deferral laws that they have, for instance, the CFC and the PFIC rules, and also the flexibility that they have in terms of how they can look at the foreign entities, and that you can actually make an election to choose an entity to be a flow-through or to actually be a blocker, so to say, or a corporation from US perspective, gives a lot of scope for structuring such an acquisition. So you may be saying from an Indian perspective, you look up and you're only looking at the Mauritius entity. Of course, you look through and guard and all of that, but you'd actually see the level up. But from a US perspective, you can make elections and your entire structure could be flow through, where it looks from a US perspective that the US entity is only holding the Indian entity. And what this helps from a US perspective is when you're exiting in terms of characterization of your income, you'd want a capital gains characterization on those assets. It becomes relevant in that case. It also becomes relevant in terms of at what time you're recognizing income in the US, because if your entire structures flow through, sometimes you could land up with a situation where actually the US investors not getting anything out of the source country, which is India in this case, but you might have the tax obligation in the US. So those things have to be very carefully looked at. I think in some cases, even though you're investing through an intermediate jurisdiction, the India-US treaty could still come into play because, again, as I mentioned, if the structure is seen as flow-through and you're looking down at the Indian entity and you're getting proceeds out of the Indian entity, there could be a situation where you want to reduce the tax that is applicable in the US on dividends. So such issues are often something that
even asset acquisition and the share
right.
that
So
could be
on
something.
that, again, depending on the threshold that a US entity is acquiring in the underlying company. So if you're say you're acquiring an 80%, 90% interest, there is possibility of making elections where you can actually, even though you're doing a share acquisition, it might be deemed to be an asset purchase where you can get a step up in assets, you can take depreciation on those fair market value of those assets. So that's a very fact-specific analysis. There are pros and cons to it, but these are the sort of things that you look at while structuring these transactions, I think. And the one thing I would like to mention, Mahesh was mentioning that there could be restructuring. So all this is not just relevant in acquisition, but in restructuring. So a lot of times you think that suppose your restructuring is taking at a non-US level. So you have a merger in India or a demerger, so to say, and you'd imagine that it doesn't have US repercussions, but that's not always correct. Because of the way you've structured it and how you've classified your entities, a completely offshore transaction could trigger US reorg provisions, and what you need to make sure is that you're falling under the tax-free reorg provisions. So I think those are the
Thank you
points
so
from
much. I
US.
think, Connie, you have some comment on the tax thing? Of course, you already said something, but if you want to add something on the subject.
Well, I have a little bit of a nightmare story that I wanted to share. I went back and actually tried to recreate the sequence of events, and it follows on very well to some of the tax issues we've been talking about. The story is that in 2008, Cisco made a minority investment in a company in India. Let's call it Company A. And we held about 5 to 8% of the company. And in 2012, they made us an offer to buy the shares back. We were happy, we wanted to sell the shares back, but they wanted to do a 20% withholding. We didn't agree to that because we do all our investments through a Mauritius entity, and we felt that that does not apply to us. So they said, okay, fine, forget the withholding. We just want uncapped indemnity. And then we said, no, that's not going to work either. So then, the parties, this is the middle of 2011, the parties just agreed to disagree. And in the meantime, the initial Vodafone decision comes around in the beginning of 2012. And we thought, well, should that make you feel more comfortable? No. This is a direct Indian investment. This is not indirect. Okay, so in the meantime, company B comes and buys company A. So we're no longer dealing with company A, we're now dealing with the new parent, company B. And they've said, well, we want 300% of the tax as our indemnity. Do you want to take the deal? And we want it to be 7 years or 9 years statute of limitations. And in fact, the market now is 3 to 5 times the tax liability. And the business people on the Cisco side kept saying, why would we take this horrible deal? Let's just let them do the 20% withholding. That's just so much less than 3 times the tax amount or unlimited. And our tax department was like, no way. We're not going to break our structure here and agree to have withholding when we feel like the treaty with Mauritius should be observed. So then here we are, and it's 2012. At the end of 2012, the cap gains rate, I believe, went from 21% to 10% in India. And then there was that advance ruling in 2012 that said that we have to observe the treaty with Mauritius and honor the treaty. So we felt like we were in a great situation. Let's go back and talk about this again. But there was just so much concern about the penalties and the interest and everything that could apply to the acquirer if they didn't do the withholding correctly. And so then it's 2013, and we finally agreed on 50% of our proceeds as the indemnity amount. But in the meantime, the rupee had declined so significantly against the dollar that the deal proceeds were like $1 million less than we thought that they were going to be. And so in May of 2014, so that's 3 years later after we got the initial offer, we finally sold these shares. So because of that story and some good advice from our firm here, we are definitely now doing new investments through Singapore and not through Mauritius.
So you can see that even though you don't make money, you still pay tax. For example, Vodafone didn't make money, they just bought shares. Who made money? $11 billion went to whom? Hutch. Nobody talked about Hutch. It was their tax liability, but Vodafone did not withhold tax, and therefore they had to go through all the things that you read in the newspapers, and still the matter is not settled completely. So that's how. So that's why tax becomes very important. But at this juncture, I would also like to change the track and look at if Simon, you could tell us a little bit about the competition law and the public company acquisitions and stuff like that in technology sector. If you can give some comments, that would be wonderful. And then Puneet, I'll come back to you for a moment, and then we'll open up to questions and answers.
Sure, thanks, Nishit. So our antitrust laws are quite nascent. They came into full effect only in 2011. And they're a blend of both the EU as well as the US antitrust laws. What's important for this panel is how does the CCI, or the Competition Commission of India, look at combinations or mergers and amalgamations. When the Act actually came into force, we had a statutory period of 210 days for the CCI to clear any acquisition or combination that crossed or that met the thresholds that required a filing. And this was perceived to be quite horrendous, given the fact that the intersection with investors and regulators have not been the best, especially coming into India. But the Competition Commission of India tried to prove that it was different from regulators like MOFCOM in China, and imposed a self-assessment period of 30 days, which thankfully the Commission has actually kept in most of the deals today. So we see a process of 30 to 45 days within which the Competition Commission of India has actually cleared transactions. Now, whether or not you need to make a filing or you need the Competition Commission approval depends on whether or not you meet the asset and turnover test at the time of making the acquisition. So the way the Indian Competition Act really works is it looks at the acquirer and it looks at the enterprise being the entity that you are going to be acquiring. The combined asset value and turnover value of these two entities is looked at to see whether or not you meet the financial thresholds. Different from the US, we don't look at relevant turnover, we look at the turnover of the enterprise in totality. So for instance, if it is that you're buying assets of company A or you're buying a specific division, just the tech division of company A, you don't necessarily need to just look at the division that you're acquiring, but you need to look at the entity as a whole to see whether the asset and turnover threshold have been met. Now, a very commonly used exemption that the central government actually gave is that any company or any enterprise that you are acquiring that has assets of less than about $40 million or turnover of less than $120 million in India is exempt from making a filing, with the Competition Commission of India. Now, especially in technology companies, we've seen, because this is an OR test, that means if you meet either of the two, you are sort of exempt from filing. Many tech companies have actually, not because they don't really have assets that cross the thresholds, have been sort of exempt from making filings. So if you're buying a small company in India, or if you're buying a company that has assets in India which are less than the stipulated amount, you have this exemption that you can rely on. But because it is, on a global level and not just the division that you're buying, many M&Cs don't really, can't really avail of this exemption, really speaking. It's more literally for very small companies that have, limited assets in India. So what's very, very, very important about this exemption is that it ends in 2016. Unless extended, the exemption ends in 2016. So we have just one more year to actually go through this exemption. Once this exemption ends, we will need to look at thresholds once again and not be able to sort of rely on this exemption squarely. What's important, when looking at antitrust in India, especially for mergers and amalgamations, is that the Indian law doesn't really apply only if you're acquiring an asset in India. It could be an absolutely global transaction, but just because that enterprise today has assets in India, even if it's a total offshore deal, you could have a situation where a filing is actually required. Again, what is very key, and what our commission has been extremely vigilant on, is at what point in time do you need to make a filing. For instance, we've seen many transactions where there is a global agreement pursuant to which the entire transaction has been structured, and maybe the India leg happens much later. Even then, what our act really says is that within 30 days of entering into any binding agreement, you need to make a filing before the Competition Commission of India. And this has become extremely important because the Competition Commission of India has been imposing a lot of penalties if you have a delayed filing. Even if it is a day or 2 days delayed, the Competition Commission of India has been levying a lot of penalties. Again, if you enter into a transaction and you do not really make a filing and you consummate that transaction, gun jumping is another issue that the Competition Commission of India frowns upon very heavily and has that has again attracted a lot of penalties. So what's very key, I think, in technology companies is, the Competition Commission of India's, the act gets triggered if you're acquiring shares, control, or assets of an enterprise that has assets or turnover in India. So we've seen a very interesting trend of jurisprudence, wherein, even if you are acquiring or if you're assigning a whole set of exclusive licenses from one entity to another, the Competition Commission of India has looked at an assignment of that sort as an acquisition of asset by one entity to another. So even transactions that are structured as assignment of contracts and things like that need to be looked at as to whether or not you would squarely fall within the framework of the Competition Commission of India.
Thank you.
So I think that that gives us a gist of what the antitrust legislation really is in India. Nishit, you also talked about public market M&A. Public market M&A is a completely different ball game. We have the regulators, the Securities Exchange Board of India. And different from the US, where you have securities regulations which get attracted for any company, the securities regulations mandated by the Securities and Exchange Board of India get triggered here only if you're acquiring a company that is listed or to be listed on the bourses or the stock exchanges in India. The minute you have an acquisition where you're acquiring more than 25% of the shares in India, it could be direct or it could be indirect, or you have a change in control, you have an obligation to make an open offer or a general public offer, which gives the opportunity to minority shareholders to actually exit out and tender their shares to the acquiring entity. Again, price and things like that are stipulated. The entire process takes a while, but it's very important to note that you cannot consummate the primary transaction unless and until you have this public announcement actually made. If it is an indirect acquisition where you're acquiring an offshore company which triggers an open offer in India, you can consummate that transaction freely. But before that, you need to make an announcement of the open offer to the minority shareholders. So, I know we're sort of running out of time. So I'm going to sort of stop at that as to how public M&A really works in India.
Thank you so much, Simone. And just last question. I think, Punit, if you could make a quick comment on ultimately what are the takeaways from all these things that we discussed? And we'll then open up questions,
Yeah, I'll keep it very brief in the interest of time. But folks, how many of you are non-lawyers here?
Most of them.
Thank God. And how many are non-lawyers not very familiar with India here? Okay. So the reason I asked that question is that if you listen to everything that the esteemed lawyers said here, it's very complicated. I don't know. I mean, after doing it for many, many years, I still find it confusing. So the takeaway here is that the issues of these legal and regulatory and tax, these three, which are interpolated and related to the structure of the transaction, are actually, unlike in US where people do transactions, they treat it as after the deal is done, it's a documentation and finalization step. So the thinking Mahesh mentioned about it, 40% time thing, in any transaction related to India, especially cross-border, this is inherent part of the transaction. So this is something that one has to plan and discuss with a prospective buyer day one, because like Kani was saying, with a lot of surprise, which only can come in because you are not so familiar with India, is that 3-year delay is not a long time. So the thing is this, right?
Yeah, we believe in this life and next life. Yeah, so, allows us enough.
One life is not enough. So basically the point being that this thing, the issues around structure related tax have to be brought up right up front, because we are currently in a transaction where the prospective buyer, after looking at the company for 2 months, after looking at all the regulatory issues, just dropped the transaction. And that's not the first time. So the key takeaway I'll mention here is that I think at least us non-lawyers will not absorb everything that the team here has mentioned. But one takeaway here is this, that if you are involved, whether as a buyer, as a seller, as an advisor, as a friend of a buyer, or as a friend of a seller, you need to make sure that this point about dealing with Indian transactions is discussed right up front, brought up front, right advisory team is put in place right up front. Typically it will involve somebody who can deal with tax matters, somebody who can deal with legal matters and regulatory matters. And this is done right up front. the buyer or the investor is completely aware of this so that the transaction is not derailed at a later stage because of it. Because this is inherent part of the transaction. That's one takeaway. The second takeaway, because I heard there are a number of budding entrepreneurs here also, is that how you structure a company initially is a critical matter in terms of what happens to the end of it. So this Singapore structuring, etc., the moment you become Flipkart, it becomes very, very complicated. So you have to think through these matters right up front to avoid this inversion, which is fancy word of flip. I think people stop using flip because it sounds too flippant. But the point is that those things become very, very difficult. So we deal regularly with companies where things like what Connie was mentioning happens, that company has done very well, but people have not seen any money, but they can't deal with it. So that's a key takeaway I leave here, because everybody cannot learn law.
Yeah. Thank you so much.
Can I add something?
Quickly.
Just one line quickly. We are doing a transaction where our client is actually bidding for purchase of shares in the company. And for last about 20 days, we have just been discussing the structuring. How do you structure so that the tax at the seller end is minimized, because then only his bid would become more attractive. And how do you structure so that the transaction gets done in a faster way, because that's the only way the bid will become attractive. So what Puneet mentioned is actually even before you give an LOI to the seller, the structuring both from tax and on regulatory perspective to reduce the transaction time and to make it tax efficient becomes very, very critical. And there are times when people have lost the deal simply because it was tax inefficient for the seller compared to some other bidder who structured it in a more favorable way.
Yeah, I think, thank you so much for the time being. And most of you has said that you're not necessarily lawyers. And the most important thing that you know about law, especially in India, is that if a company commits a default, then the directors become liable, including for tax. If it's an unlisted company and if it doesn't pay tax, maybe you wind up and then you find out after 5 years that you were liable. So even if you're a director of a company, it is very important to know that some of these situations arise. Normally you absolve, but I think these are some of the things which you really need to bear in mind. That's why this session. Maybe we are running really out of time, our fault, of course, in some ways, but still we would like to take 1 or 2 questions and take up to coffee or tea, if you don't mind.
I'm KRS Murthy. I'm in M&A. We discussed how a foreign entity like USA acquires assets or stocks and so on through Mauritius or Singapore. What about the reverse? Because I get a lot of requests from Indian entrepreneurs and people who seem to have money for infusion of cash or acquisition of some assets or the company in USA. Probably they want to have.
I understand. Let me respond to that question just so that we can be quick. US has very interesting situation. It does not tax foreign shareholders when they sell US incorporated entity, US Inc. So Indians selling shares of a US company pay no capital gains tax in the US. Because according to the US, the shares are cited in India, and Indian shareholders, the whole thing is outside, they do not tax. So even if I make $1 billion out of that, the difficulty I see often is that most of the time when small or other businesses are set up in the US by local US investors, so residents, they're set up in the form of an LLC and check the box. Now, if as an Indian company I acquire the interest in LLC, it would be deemed that I am acquiring the underlying assets. Okay. The moment I do that, in future if I transfer the interest of an LLC, I would be deemed to have disposed of those assets and not the shares. And therefore, you will become liable. Not only that, but on an ongoing basis, that may fall into the trap of ECI, effectively connected income, or kind of permanent establishment. So you also continue to pay tax. So typical way in which we will, don't hold us to that, these are only some ideas I am throwing up, is that if you are an LLC, best thing is to acquire the same through perhaps a Delaware Inc., which will own those shares. and Delaware Inc. can be further acquired by an intermediate entity, neither Indian nor the US, say somewhere in the UK or somewhere else, so that you box, because the moment you sell the US company shares, even if you do not receive full proceeds, sometimes deferred payment, you have to pay tax in India. So you have to block it in between somewhere. So typical transaction would be India, intermediate entity, non-US, non-India, US incorporated entity, and the LLC. If I can summarize.
Also there are exchange control requirements which an Indian company will need to keep in mind before they acquire a US company, right? From what is the amount they can do, and what are conditions attached to that particular amount, and whether they require approval or they not require approval, what kind of industry it is. For example, financial services industry or a holding company itself can create some additional conditional.
See, unfortunate part is that India has not globalized its laws yet. So they don't understand sometimes, because we are a closed economy, so most of the laws are written in a way that India-centric, but not the overseas. So that's one of the things hopefully we'll see some change in times to come. May I have any other question? Yes, quick please.
I'm Siddharth. I operate a marketing automation technology company. I want to
Out
understand.
of where?
Out of India, Delhi.
Okay.
So since it's a technology company, I want to understand whether incorporating it as a LLP or a private limited company, does that have any impact on M&A?
In India?
Yeah. So if some US company wants to acquire a technology company in India.
Okay, without going into too much of detail, if you are going to have VC or private equity investment or some kind of, better to start with the company itself, private limited company. LLP regime it's a new regime in India. If foreigners have to invest, you have to go and take special approval of the government. Not only that, how it will be treated for US purposes, and because it will be, whether they will check the box or not check the box, there are some more complicated tax issues involved. And difficulty with LLP in India is that the jurisprudence has yet not settled. So what has happened, the way in which we have written laws are not sufficiently clear. We neither took clearly what you call the UK model or the Delaware or the US, we drafted our own way, and therefore there are some issues to drafting. So only if you are a very close group of companies, we recommend to set up LLP, but generally we prefer to have a private limited company if you're going to have external investment. Thank you so much, I think.
Real quick.
You can introduce yourself as well.
Yeah, Scott Wentz, I'm a tax consultant here in San
They are
Francisco.
leading tax consultants here, yeah.
We've been to Bangalore and we see entrepreneurs and they're like, well, it's difficult to set up an Indian company. What do you think about setting up our operation in a Delaware C Corp?
Yeah.
Because then we can do more transactions quickly, or they're doing what some people mentioned in terms of thinking ahead as to what is their exit.
You're talking from Indian perspective or the US perspective?
So these are Indian entrepreneurs in India. Everything is done in India.
So whether to set up Delaware company or not, right? That's your question.
Yes.
Okay, my straight answer to that, and again, do not generalize completely. We do not recommend people to set up a US headquartered company. It's a bad idea from Indian perspective because you are taxed on worldwide income. We would rather set up a non-India holding company which will do non-India business. Only for the US local business we'll recommend that. Now, because otherwise what happens, if you are in Infosys, for example, you get 100% tax exemption on special economic zone in India, okay, or somewhere else. But if you are a US company with special economic zone benefit in India, there is no tax in India, but you end up paying tax here. From tax perspective, we do not like it as a starting point, but eventually if somebody is going to give you a lot more money in the US, do it. Everything, there is a price.
Also, we have just written a booklet which is outside at the reception on Startup Toolkit, what you need to know. In that, we have addressed this particular question about Indian entrepreneurs who want to have a global business. on what are the structuring issues, what they can do in setting up, what they need to meet if they want to set up a US company or a non-Indian company. So I just thought I'll allude to that.
But it's very important to design the whole structure, because you have still a lot of things to be done in the US. So you still need a US entity, you need to comply with a lot of rules and regulations. But from a global perspective, we prefer not to have a company. All of you, I think those who are non-lawyers, most of you must be reading about inversions. Inversions is the biggest nightmare in the US now, all the more. So instead of doing inversion, do not start here. If you start elsewhere and if you find later on, oh, you want to do it US, then you can always bring to the US. US will welcome you. But as a starting point, we do not generally advise that US parent company be set up. Then it's situational. I will just take very quick question, because everybody's waiting for tea and coffee. We bored them so much, they want some coffee to wake up. Okay.
So hi, Nishit, I'm Manish Agrawal. So I run 12 different companies. So one of my favorite child is Science in Box. So what I'm planning to do is, I'm looking for a company to have some investment made in my company, so that I can procure some of the very high-end scientific instruments from US. Now, would that, and if it comes at a lower price than the fair market price, would that anti-dumping law will be applicable?
Anti-dumping, I think, is in the context of import-export of goods.
But if a company which invests in my company has a sister concern which supplies, let's say, very high-end optic instruments.
See what happens, I would not go too deep into that. Number of issues, one, related party transactions will come into play immediately. Okay, you have, if it's goods, again, whether you're in compliance with either FEMA regulations, customs regulations, and those kind of things. I'd be happy to take up separately, because this is slightly more complex.
Yeah,
but today you have a free day, you don't pay fees if you want to ask questions. Okay. There are lots of hands. I can only do one thing, because I can only take a vote if majority of the people have no objection to taking one or two questions and we are delayed. So you consciously vote for it. So is it okay to take one or two questions? Yeah. Okay, fine. Thank you. So we'll give 5 more minutes and go for coffee, and to that extent will be delayed. Just bear in mind. Thank you. Yeah, okay, why don't you, okay.
Hello, I'm Satish Pathak here. I'm a technology innovator and now have plans to build a new venture, manufacturing venture based on my patented technology in industrial valves. Before coming
in India or in US?
That option is open, so the question comes to there itself. Before coming here, we had been to Austin. And we had been greeted there that you come up with your innovations and we will provide you all the initial support to build your company here in Austin. So what is your take on that?
A couple of things, is your business going to be global? If your business is going to be global, and again, whether patents are already there or what, I don't know.
Patents are already there, and the new versions would be for the global patents as well.
Okay, so you see what has happened lately, there is a race to the bottom in Europe. Number of countries have brought in regulations for what is called, kind of patent box regime, under which, like UK, if you have patent done in the UK and you earn royalties or other things from worldwide, maximum tax rate is 10%. Netherlands has innovation box. So if you have it there, it takes only 5%. Okay. Singapore has just come up with about 10%. Italy has just come up to 10%. Okay. So this is how, on the one hand, they all talked about harmful tax competition and all the thing. Otherwise, there is a lot of activity going on. Every country wants to house an IP. Every country wants an innovation and idea, So they are now coming up. So you can choose one of those jurisdictions, slightly elaborate exercise and sometimes a little more expensive.
It's not only limited to licensing of the patent, but basically it's to have a manufacturing activity and to promote the industrial products.
Correct. So when you manufacture, you still need IP from somewhere, right?
Yeah.
So either that company itself can own an IP,
Yeah.
or some other company can own IP and license to your US company.
True.
Okay. And I think Scott and some other people can also advise you better on overall structuring. But we take a global perspective and suggest that this is how possibly you can, these are the options available, and each of the jurisdiction then we work with the lawyers and accountants and to finalize the structure. So it's if it's going to be a big business, then it's worth doing it. Otherwise you can set up companies everywhere, and setting up companies is not a problem. It's like having babies. It's very easy to have one.
True.
But to manage and maintain throughout the life is
very true. But where to have it is also an interesting
so
question.
just be careful on that. If you don't mind, I move to the next question.
Sure, thank you.
There is a gentleman in the red.
Yeah. Hi,
Yeah.
I'm Ishwar Murthy. I run a BPO company, and it has a US subsidiary. And in the recent budget, they have talked something about POEM. The place of effective management.
Generally, poetries are very beautiful, but Indian context is a little ugly.
Mine may be very small right now, but I'm just curious on, because US subsidiary, we are being taxed in US also. But I'm just curious on how that affects us.
See, simple concept of POEM. POEM is what? Place of effective management. Current rule in India is that if you are incorporated in India, you are an Indian tax resident company. If the company incorporate outside, India is wholly controlled and managed, 100%, not even 99, that's a judgment. Wholly controlled and managed from India, the foreign company could also be considered to be resident. This is, so law is very clear, and over 113 years or so, there have been hardly any litigation. Now, this year there is a wrinkle. The tax department said that if the foreign company is controlled or managed from India, and it falls into the trap of POEM, place of effective control. Now, what is effective control? Are the shareholders, are the directors, and those kind of things. So that wrinkle has been put in, and it has created some uncertainties that even if you have a US company, but you have a couple of directors in India, you hold some board meetings in India, and you do some of those things, then the whole of the US company can be deemed to be tax resident of India and therefore taxed on worldwide income. And you are incorporated in the US, and therefore you are again taxed on the worldwide income. So you got conflicting situation arising, and therefore one has to be very careful when you bring Indian people on the board, or where to hold board meetings and stuff like that. So that's all about POEM. At the moment we made a lot of noise against this. So there is some clarification issue. They are trying to give a comfort. Don't worry about, nothing will happen and stuff like that. But I think you take it as you like it. Quickly, yeah. Your name and
technology company.
Sorry, I couldn't hear.
I'm Vasant Ravula.
Yeah.
I'm from technology company.
In
India. And the question is, like, if a private investor or venture capitalist trying to invest in a company in India, so what is the route? What is the
private? I'm sorry.
So venture capitalist is planning to invest a company in India.
In your company.
In our company.
Okay.
So what are the implications? Like, how do they do? What do they need to do?
Can you read this book, which is going to be distributed, a startup?
The entire session.
It would be very helpful because it's a little longer answer. That's
also,
why I don't mind.
Also, if you are there for session 4, we will be dealing some of the questions there too on the exits and other stuff. But
one last for the road.
Hi Nishit, Vishal. I'm building a healthcare software. My question was, as an entrepreneur, I wanted to understand the exit kind of strategy. How, for an entrepreneur who is planning to set up, say, an entity here, not a headquarter, but more like an entity in America, just to help him raise funding. Now, if it doesn't work out, what are the implications when it comes to an exit?
Puneet, you want to say? I think the right question for you.
Yeah, so again, like many of the questions, it requires a more detailed answer. But in general, investors and capitalists want to put in the parent company. Raising money in a subsidiary is a very risky thing because, that's very simply that means value can be transferred to the parent and the investors in the subsidiary may be left hanging. So in general, you will find lack of interest. My kind of very high level, which requires a lot more kind of groundwork, is that at your stages where we were talking about earlier, maybe you want to consider a outside India, outside US holding company, where you raise the money, Singapore maybe. That makes things much easier. Being in India itself is also difficult. So Indian owned is not very good, US owned is not very good.
Thank you. So thank you very much for this wonderful interaction. I really appreciate. Just don't go away, and let's have a big round of applause for the panel. Thank you so much.